It's definitely time to grow and scale your business, but make sure you have your financial house in order before you do so. Here are 4 financial calculations you're going to want to make sure you have a good hold of before you start the scaling process.
Hi, welcome back to Blunt Force Business. I'm Brian LaFauci.
I'm Patrick Marino.
And today, our blunt force fact for you is you can't build a skyscraper on a shaky foundation.
Today, we are going to talk about scaling, and we're going to talk about the financial things you need to be able to do, or you should have in order before you scale your business. This is a Brian LaFauci method of consulting subject. Really looking forward to this one, Brian.
This is a math class. Today is a math class. So I think for all our math geeks out there, for all our business owners that love to dig into numbers, the ones that love to run reports, or for the business owners that don't do any of this, this is going to be an education to answer the question. I want to grow. I got this idea. I don't know if I'm ready, because we hear that all the time. I don't know if I'm ready. So we're trying to systematize for our listeners how you can be best prepared. And there's some operation ways to do that. There's some personnel that has to be looked at. But one of the key components that we can use to really dig into that are key financial metrics. And we're going to give them 1, 2, 3, 4.
Nice. I'm really looking forward to it. But we've been talking about scaling for the past couple of weeks with our business growth group. And I think that it's all the things. I think that having this part down and having a strategy for this would take a lot of the weight off of people's shoulders. Because I know the other stuff, we talk about more often, should you hire more people, or should you try and get more business before you scale, or should you find a new location? And we've talked about that on prior podcasts. But I think that this part, like knowing that your finances are in order, would give you the peace of mind, because the non-zero risk to this is that your business falls apart. And if you kind of got this down, I think that it would put a lot of people's minds at rest and allow them the freedom to decide to scale.
Absolutely. So the big one, can we jump into to our 4? Do we want?
Yes, absolutely.
Want to give them all 4? Do you want to just get into the first one right now?
Well, why don't you go ahead and do it however you want to do it?
All right. I'm going to tease the 4th one is the most important. Stay till the end.
Oh, okay. So you gotta wait till the end to get the 4th one.
You gotta wait till the end for the most important one. I mean, it'd be silly to do it otherwise. All right. But one of the key financial metrics that I want everyone to start with, to really dig in and say, all right, are we built for success right now? Are we not building a skyscraper on a shaky foundation? Is your current return on investment. And you might say, why does that really matter? Say that. Say, Patrick. Say.
Why does that really matter? Why does your current return on investment really matter, Brian?
Because that financial metric, that one number that one math equation is going to tell you exactly how well your current business is turning its assets into profits. So when you think about it, what's scaling all about? It's we're going to quote unquote grow and potentially add more liabilities, right? So before we're going to grow and add more liabilities, are the current assets we have returning a significant amount of investment? Because if they're not, right out the gate, if what we are currently have for a team, if that team's one person or 2 people or a couple people in some systems or a warehouse, right? And so when we talk about assets, this is important, because assets are both physical, human capital, which is a massive asset, right? And all the other things, how much cash we have on hand, what do we have for physical assets that we own, all things like that. And how much of that is actually turning into income. We may find that financially we got a bunch of stuff, but a lot of it isn't making us any income. We can, what the perfect example of that is? A perfect example of that is the young entrepreneur who goes out, starts a company, right? And starts making a little money and goes and buys a really nice car for himself to drive around in, right? That car is an asset, but makes the business no money. So this is a great way to just say right now, before we scale, are we spending our money wisely, right? Is the stuff that we are investing in stuff that actually produces for us, right? And there's industry benchmarks for this. That's why I like this one. So you can very easily look up whatever your company is and what the industry benchmark is. And it'll be a percentage, right? So the math equation for return on investment is you take your net income. So whatever period of time, usually a year, you take your net income for the year, and then you divide that by your average total assets. And the word average is important there because business assets kind of trend up and down. So usually what you'll do is you'll take like your balance sheet from this year and last year, and you'll add your total assets together and divide by 2. You'll get a nice little average on that. And then you will use that as the number. So net income divided by average total assets will give you your return on investment. Return on investments can range from like 10% up, maybe up to 30%. And like I said, every industry is going to have different ones, but this is going to give you a really good benchmark for how much shit you got right now and how well you are using it to make you money. Because if we're going to
find
go,
do you sorry to interrupt, but do you find that when you're consulting with businesses on this aspect of it, that companies might find out that they're actually not profitable? Because I would assume that as long as the company is making money, then this is going to be a plus. This is going to be a positive, right? So then are we looking then for how positive by percentage? Like, are we looking for like, what's our return? Is it really high percentage wise? Because as long as we're profitable, our return is going to be a positive number. Mm-hmm. Right? It's going to be a positive percentage. So what are we looking for here when we're thinking about what this return needs to be in order to be in that safe zone and maybe think about a scaling strategy?
So you'll know if this is negative. This very well can be negative, by the way, because if you have a year, right? Let's say you're tracking this year over year. If you have a year where you invested a lot in growth, that year your net income may be a negative number, right? Let's say you dumped a bunch of money.
To be fair, I wasn't thinking it through when I said it. I should have thought about it through. But yeah, so like if we're already on a scaling path, or if we've taken out a loan or something like that to pay for like a piece of equipment that we haven't bought, like that, or we've made a big capital investment.
Yep.
That's going to pay off down the road.
Yep.
So if we're negative in the ROI, then at that point, then maybe we're not in the best position to scale.
Right. If you have, if your balance sheet shows that you have $100,000 of total assets and the business made $10,000 net income last year, then you're going to be at a 10% ROI, right? So you're returning to yourself or your company 10% on the assets that you have to use at your disposal. And think about it. If you think about that rationally, a company like a service-based company, what are the assets they have to use at their disposal? Most of it is cash, right? Liquidity. You may have some vehicles, right? But most of it's just cash. We got computers. So our assets are not going to look anything like a landscape company that has trucks and equipment and all stuff like that, right? So the asset number is going to be, what do you have for liquid cash and how well are you using it to make income, right? What's your liquidity? What are you using to make income? Now, a landscape company is going to take a look at this, and their assets might be significant, but it answers the same question. It's great that you have all this stuff. How much of it is getting leveraged for your bottom line, right? How well are you using it to make income? So the beauty of all of these equations are You know what they do is they create an even playing field. So they allow a company that maybe makes $2 million and a company that makes $500,000 to actually be compared to each other, even though their top line earnings are completely different. Because you could have a company that's making $500,000 a year and their ROI is 20%. And if you have a company making $2 million a year and the ROI is 10%, the better company to invest in is the smaller company, right? So this is a really good metric to see that. And if you're going to look to scale, right, sometimes when we scale, there are things that happen that may drive our ROI down at first. That should be what happened, because if we're going to invest in people or stuff, like the landscape company is a great example, stick with it. If we invest in people or stuff, let's say we like, all right, let's buy a second truck and get out on the road. Like plumbers deal with this all the time, like any construction. Do we buy another truck, right? The minute you do that, your ROI is going to drop, because that expense is going to reduce your net income. Yes, you've added some assets, but overall, your percentage ROI usually is going to drop down a bit. Then the goal is now, okay, over the next year, can that truck produce enough that at the end of the year, it drove our ROI back up again?
What if we take the example of that we actually brought up in our last group of the other way of scaling, which might not be the best way of doing it, which is to kind of sell a bunch of stuff and then figure out how you're going to develop it after, right? So it'd be like, if I'm the plumber, let's say I go out and get a bunch of jobs that I can't handle, and then I have to buy the truck. How's that?
Well, pre-booking, I'm a big fan of overbooking your flight, right?
Right.
If you have the systems in place, right, and that's the big thing, right? And we're not talking about that on today's call, but if you got the systems in place, I love the idea of booking workout with the plan of, all right, when we hit this target number, we're pulling the trigger. We're bringing, we're hiring that next person and getting that next truck. Yeah. And I think in some service industries, you can do that because people expect delay. Like I'm getting a boiler done at my house because the boiler cracked. Well, when I gave him the go ahead, he told me the lead time was 3 to 4 weeks. I'm already waiting, right? So to everyone he's quoting 3 to 4 weeks, so he potentially could just book more and more business till he has enough there that he's like, I can keep a guy busy for 2 months. I should be in a good spot to hire the next guy and then go on board that next guy.
Right.
I think there's a lot of industries you can do that because the customer's expecting the delay. I wonder, I don't know the answer to this, but I would be willing to bet that the airline industry plays this game a lot because most people book their flights way in advance, where they then look at it and say, we may need a new plane. And maybe they, you ever book a plane flight and they'll be like, oh, I booked it on American, but it says operated by.
Yeah.
Yeah. I think, those relationships are built on that. Like, hey, if we oversell, can we subcontract with you to do this route? And then if the route gets popular enough, maybe then they pay for the new plane to do it themselves. But good stuff. All right. Any other questions on that one?
Oh,
all right.
Go ahead. What's number two?
Number two.
So we want to make sure we have a good enough ROI. We're tracking all this, right? So we're starting off with our ROI.
All right. So the most important thing you can do is we gave you the equation. We'll do a worksheet because I think this is a great class for a worksheet, so you can just remember the equations. Then you got to do your research on what the industry standard is. That is an easy Chat GPT ask, right? What's the ROI industry standard for a plumbing company, an HVAC company? So, and you'll get that, right? We could give them out today would make no sense because they're all going to be different, but you'll at least know what you're tracking in comparison to your industry and where you should be. Oh, and then the last piece of that is, what is your determining factor? Well, you want to be above the average if you're going to take that step to scale, right? Get yourself slightly above the average because you're going to take a bump down usually when you scale, at least the first little bit. All right. Number two is return on equity. And I love this one because this is not one that most people would say it really matters. but it matters to us as business owners. So return on equity shows how much profit you're generating per every dollar of owner equity. So if you invested in your company, right, and you said it took me, it cost me $50,000 to get this company off the ground, right? So you got your initial investment, and then you've now built up stockholder equity. So the equation for stockholder equity is pretty straightforward. You take your asset, it's a balance sheet equation. You take your assets, you subtract your liabilities, that's your stockholder equity. So what your return on equity is, you do the same thing as return on investment. You look at just this. So in return on investment, we took an average asset as the bottom line of the equation, right? Now we just take the average stockholder equity. Same thing. What is our stockholder equity at the end of this year? What was it at the end of last year? Divide it by 2, get the average. So now we know about what our stake in this business is worth. And then we put that at the bottom. We put the same thing at the top, net income. So net income divided by average stockholder equity, and we're going to get a percentage. And you can see in both these equations, the bottom line number is always more, right? So it's never going to be 1. Okay, we're always going to be, you're going to be sub 1, right? So return on equity is important, because when we go to scale, very frequently we ask private money to come in. We may ask a buddy, a family member, a private investment company. We may go somewhere other than the bank. And the minute we go somewhere other than the bank, the most important thing they care about is, what's my return on equity? How much money does the company make per every dollar invested? So if I have...
So let's say I'm starting out. So let's say like I have a electrical contracting company, right? I got a few trucks, I got people working for me. So, but I'm the owner. So I'm the sole owner of the company, even if it's an LLC, right? It's a pass-through, right? So I'm the one who owns the company. So basically I'm taking what I put in at the beginning to get the company started. Is that my equity in the company?
A cash injection from at the very beginning, a cash injection does go onto the balance sheet as owner equity. Yep. And then from there, so quick accounting 101.
Because I would think that most of the companies in our listenership, people that listen to this, people that follow our brand, are going to be kind of smaller, right? They're not going to necessarily be public companies or private companies who are out there raising a ton of capital.
And a
couple people who watch this stuff, but like for the most part, we're talking about single owners or like it's just like a partnership. Me and Joe own this company together. We started it together. We both 50-50 owners, or we're 30-30-10, whatever we are. We're in some sort of like one of these partnerships. I think that's the majority of our people. So maybe define that in that circumstance. It's probably easy, but maybe just for the people who are tracking this.
Yeah, and this 100% applies to even, your company is a single owner LLC. My company, single owner LLC. This 100% applies to those, right? Knowing your quote unquote stockholder equity doesn't necessarily mean you have to be listed for public sale, doesn't mean that you have to have stock investors. It's knowing what, when you create your LLC, your attorney gives you like this nice little feel-good piece of paper with your shares on it, right? Like, here's your shares in your own company, right? Great. And so the initial cash investment, like you said, yes, that falls under your stockholder equity. And then whatever other money is sitting in that business, you take the assets on the balance sheet, you subtract the liabilities, right? Assets, all the stuff we have and own, you subtract the liability, and what you have left is the stockholder equity, okay? So at the end of the day, it's good to know, what is my dollar worth in this company? And for every dollar I have in this company, what is it making me? Right. So that's the equation breaks, and this will break down to a percentage too. So your return on equity will be a percentage. If nothing else, if you if you aren't looking to bring in any investors, you're looking to scale organically, why does this matter? Well, it matters because it's important to know how much profit are you earning for yourself right now with what's already there, right? So if that number is low, maybe that is an indicator of it's low because, I need help. Maybe that's what's driving this, right? But you also need to keep in mind that if it's really low, we may be building on a shaky foundation, because what happens if it gets to a point where it's now zero? Well, then we don't have a really strong foundation there. There
Okay, and
also
a lot of early scaling operation that would dip, as you said. So if we're already starting off from a low point, we don't want to dip below that point, because then we could be in potential trouble in terms of being able to pay our actual bills and that kind of thing.
Correct. So it's a great way of just knowing, like, where am I right now? Am I earning on what I've invested in this company? You see this on Shark Tank. One of the ones that stood out really significantly for me was there was a guy.
People still watch Shark Tank? Is it still a thing?
It's still a thing, and I play it in a lot of our entrepreneurial classes with the kids because they really enjoy it. But there was a guy who did this handle for a baby carrier, right? And it was because when you walk with a baby carrier, your elbows are kind of turned in, right? If you hold the handle. So it's not natural. So he just created this handle that went on the thing, and then your hand was in a natural position.
Like this?
No, like this. So the hand, your hand would, if you just put your hand down your side now, just put your hand just straighten. Yeah. So you walk like that because the handle turned. You get what I'm saying? Like it
versus like this is how I push my baby.
Like that, which like this or like this, that's not good for your wrist or your elbow. So anyways, it was a cool idea. But their big concern was, they asked him how much he'd invested. And he was like, I've invested $750,000 of my own money. And they were horrified because they didn't see how the return on investment was going to be good if it cost that much to get to this point on the thing. And then, so it's also looking at, are we spending too much? Have we invested too much into this thing where now it's not producing what it needs to? So it's a great indicator and a great way to just now look back. You're the owner. Where are you currently lying, and where are you in the industry? If your return on investment is really low, you're going to struggle to bring in money for sure, and to be able to promise money. I can't promise you, Patrick, that I'll give you 10% every year on 100,000 if I'm currently only making for myself 6. You get what I'm saying? So It gives you an indicator of, if I do go get money and I need to pay people back, can I? Are we on track to do that? So return on investment, return on equity, 2 really good ones. All right.
Great. What's number 3, Mr. LaFauci?
Number three. I'm going to skip over number 3 because number 3, I'm going to leave number 3.
Number 3 is the one that we teased for the end?
Number 3 we teased for the end.
All right, great. So we're going for number 4. What's the number 4 financial that you really want to have figured out?
Current.
And
well, they will.
And a good handle on.
3, right? It's number 4. It's number 3 in your
heart. How about this? What's the third? What's the third financial?
Current ratio. The
current
third
ratio
one is current ratio, and what your current ratio is, it's very simple. It's your current assets divided by your current liabilities. It's very much and you'll notice with most of these, net income is the only real profit and loss sheet number we're grabbing. The rest of this is all balance sheet type numbers, right? So if you're wondering where you grab this, just for a little tutorial, for those of you that are kind of new to really digging in, because a lot of business owners don't get real comfortable with their numbers sometimes, right? So if you want to know where you grab these numbers, your net income, you would grab off your profit and loss sheet. If you have a bookkeeper or something, or someone that does that for you, you could just ask them for that. Your average total assets would come off your balance sheet. Your liabilities and your stockholder equity also would come off your balance sheet, right? So now the current ratio is a balance sheet equation. What is a balance sheet? It's literally a snapshot of your financial situation at a moment in time. Whereas a profit and loss statement is a history. A profit and loss statement never is, it's never just like one moment. It's from this month day to this month day. What did we do? Balance sheet is today, right now, what do we have? So current ratio is current assets divided by current liabilities. So good shit, debt, right? Stuff we own over debt. And you know what I'm going to say here, because I've said it in every one, the average is different for each industry. Every industry is going to have a different current ratio that it should expect, and a different number that makes it viable. So current ratio is right there with the last one that we have. That is also,
we've been teasing the most important one right that you need to know.
It's so close. It's so close. We just gave you the tip with the current ratio. Now we'll go all in, right? The fourth and number one thing you can do to know if you're ready is an acid test ratio. And no, we're not going to take an 8-hour trip into La La Land with our acid test ratio. Acid test.
Well, what I usually do is I make my most important business decisions when I'm tripping, because it gives me like a good, it gives me a, it puts me in the right frame of mind, it opens up the doors in my
Although I did hear, is it
psychology.
Google right now? Is it Google that's allowing microdosing during brainstorming sessions?
Oh, I don't know.
One of the major companies right now, and listen, I'm not against it at all. But for this acid test ratio, why is it more important than current ratio? So acid test ratio, it's more important because it deals with the thing that you need to survive on a day-to-day, which is cash and liquidity. Okay, where current ratio just is assets, which includes cash, but all the other shit you got. So the problem with that is some of that stuff could be a building, right? And if stuff goes bad, to liquidate that building is going to take a long time. And you may not be able to pay your vendor in 30 days or 60 days or 90 days because you got to sell this building and find a buyer and get to a closing, right? What the acid test ratio does is it breaks down, it takes just the things that are going to be liquid or can be liquid quick or coming in. So cash, any accounts receivable, like, hey, I booked this work and they're going to be paying me in 30 days. And anything that is a liquid that's an investment that you could liquefy very quickly. So what's an example of that? Well, my company sits a bunch of money in a money market that I can grab and have in my account in 3 days, right? I buy 1 month CDs. Those will probably be considered a pretty liquid investment. I can get it pretty quickly. So now we just take those things. So what do we kick out of this equation? The building, right? The stuff that is more tangible, would require a lot of work to turn into cash. We dump that. So we take the cash, accounts receivable, and stuff.
When you say you dump that, it's just not included in the equation.
Including the equation, because now, obviously, your current ratio is going to be higher. It's going to be a higher number than your acid test ratio. And it's going to be that way because your current ratio is including like the buildings and all that stuff. So that number is higher. So the number on top's bigger. So whenever you're dividing into a bigger number, so current ratio, current assets are on top, current liabilities are on the bottom. So if this number is bigger, you're going to get more. A good current ratio is like 2. So what does that mean? Well, if we have double assets compared to our liabilities, we're pretty solvent, right? A good acid test ratio is a little above 1. Because if we have enough cash to take care of all our liabilities, then we're in a good shape, right? That means, what does that mean? If nothing came in, we could pay off all the debt. right? If
Would
no other money came in, we could pay off all the debt. So the current
would product on hand be something that we can include in this, or would
depending
that be
how
something that
quickly,
would fail the asset test because we'd have to obviously if it's already on order that's different, but if we have it on hand and it's not been ordered,
if it's on hand and you could
or even how about this, not even just product but supplies to produce the product.
That's a
right?
great example. So
because like let's say we produce whatever it is we produce. We have to accumulate all this stuff in order to produce the products we produce, but we have to produce the product in order to sell it. So we have all this shit that's just on hand, whether it's lumber or whether it's plastic materials or solvents or glues or whatever it is that we need, ingredients to produce the product that's going to go out the door.
Yep.
We can't just, we might not be able to just get rid of that, return it back to the manufacturer, or like how does that? I guess it depends, but like maybe I don't know if you've had those examples.
Yeah, absolutely have. Prime example of that is think about a manufacturing company that manufactures in metals. At any given time, they probably have $100,000 plus of, depending what they do, could be way more, of metal bars just sitting on the shelf, right? They're going to pull them out when they're going to work in nickel or nickel cadmium mix or whatever they're doing. That's how you evaluate those is interesting, right? Because if it's a straight metal that I could go to the recycling yard tomorrow and get a per pound dollar on, I could assign that number to it, right? If I can easily dump it, and I know I can, then I can include it. If we lie, like the thing to keep in mind is there's subjectivity here, but if we lie to ourselves, we're not helping ourselves, right? But if you say, I can liquidate that metal, but if you say you can liquidate that metal, it changes the value of it, right? Because if you're liquidating it, you're probably getting pennies on the dollar. So that's the number you would have to use, right?
Right. So if I was a jeweler, I'd have gold on hand that I can, because I'm constantly turning over gold, but it's worth more if it's on the shelf in a piece of produced material that I can sell than it is if it's in this form where I'm going to have to literally liquidate it or find a buyer or whatever. But even so, it might be worth more if I have it unproduced than if I produce it into a product, right? Like, how does that?
Yeah, and so you would analyze it that way, right? So if I have just raw gold, melted down gold, gold's nice because it's easy. It's got a standard, like you can go on.
Right. There's a pretty good idea of what the market is for that.
Yeah.
And
I think gold is pretty
liquidate
gold, you could liquidate gold pretty easily. I would feel really confident if someone said, well, I have $200,000 in just gold bars. I'd be like, okay,
right.
We could.
The finished jewelry though would only be worth what it's easily melted down into versus
when you go to a pawn, right? You go to a pawn shop with gold, or if you go to a jeweler that sometimes buys back precious metals, they're not paying you. You're gonna get the rate of the the wholesale rate on it. So that they can turn it into a profit. But you could still include that number in there. So it would be that number. It would be looking at things. So if we had to do that, then we could say, you know what, I'm going to include this in my acid test number, just the wholesale value of it. Four main things. All four are important. These are the four financial metrics that you need to run down in order to know that, hey, we're ready to grow and we're in a good position. So quick recap: return on investment, return on equity, 1 and 2, start there. Then we're going to jump to number 3 and 4, probably 2 of the more important. The last one I feel the most important is you're going to do your current ratio analysis and your acid test ratio. The acid test ratio is the only one that you've got to dig in a little bit to a couple of the, you got to look at inventory a little bit. You have to look at your accounts receivable. You got to pull some numbers together. But that's the best one to tell you, if I have to liquidate and I have to pay a bunch of liabilities that I have, do I have the liquidity on hand to do it? And if you have an acid test ratio of a little over 1, if you got a current ratio of 2, and if your other numbers are a little above industry average, let's go scale.
Yeah, let's build, man. Let's build, let's grow. Because obviously, every scaling exercise, whatever you decide to do, whatever path you take to scale your business, you are risking financially somehow, right? So the better off your house is in order, the stronger the foundation, the more prepared you are for the growth. The more you have to lose just in case something goes wrong.
Blunt force fact. You can't build a skyscraper on a shaky foundation. Use these four
Well,
tools. Use these four tools for a rock solid foundation.
I hope that people are enjoying this content here because hopefully everybody's looking to scale. And just by taking these, I think this, I think that like a lot of our people, the people that listen to us, people that follow us, just having these figures ready would make them feel better.
Absolutely.
Right? Because I think a lot of business owners aren't looking at this stuff all the time, and that might figure into why they would be anxious about growing and making decisions because they're like, I know I'm doing well enough to have enough money, but like, how well am I really doing? So having this down, I think would be good.
And I'll tell you, you go to a bank and you know these metrics right out the gate, and you're like, hey, listen, I'm looking to scale, looking at a little loan. I've analyzed my numbers. Here's what my current ratio looks like. They're gonna know your shit. And if they have confidence in you, they're much more likely to lend to you if they feel like you are comfortable and confident in your financial acumen, without a doubt.
Good stuff.
All right, I'm Brian LaFauci.
Patrick Marino.
Until next time, and the time after that, and the time after that.
Thank you.